The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Welcome to Winning in Retirement. I'm Brian Akers, president and founder of Akers Financial Group, and we welcome you to our show, Winning in Retirement. This radio podcast is for you, the listener, to understand the concepts of financial planning and how to apply it to your everyday life. Today's show is pretty awesome, so I had to bring off the bench one of our experts, one of our superstars, Alex Monk. Been with me 13 years. Can you believe that, Monk?
Oh my gosh. So I look at the pictures when I first started and how bad my hair was. I'm so happy it's all gone now.
We can't show you on radio what happened to his hair over those years. Maybe that is something our website should cover. But generally, I was going to try to make that into a tax comment, but I can't do it.
Well, having hair is taxing, Brian. So,
It's a lot of work to have hair. You do have to get it cut and stuff like that. When you just shave everything, it's easy. You can do it yourself.
Yeah.
And that's almost the way we're going to do this radio show when it comes to taxes. The topic is called Plan Your Taxes, Don't Just File. The concept's like this. Taxes are more complex, so it's like having hair where you need more work than if you just shave it off.
Oh, yeah. I mean,
do it yourself.
You can use all types of products. I don't know much about the hair products. My wife asked me, like, what do you think about this? And I'm like, I'm not really the expert in that. But if you show me your W-2...
Yeah.
Or if you want to know your tax bracket or something super nerdy like that, I'm your guy.
All right. So the first concept we're going to cover is this thing of, is taxes a science, just math, where you go in to see the person, your tax person, and you dump it there and you walk out? Or is it an art? What's your opinion of art versus science of taxes?
Well, I'm not really good at either of those things.
So you can't color too well?
But I'm really good at gray area.
Gray area.
Yeah, so like in taxes, there's a lot of what, you hear people talk about gray area.
Yeah, you have to interpret.
Right, you need to interpret things. And so,
apply it to that situation.
Right, and it's a tough show because like everyone, they want to listen for that one tip. Oh yeah, I need to deduct 30% of my house. But that doesn't exist, right? Like you need a guy doing your taxes that knows stuff about you.
You have to actually talk to your accountant, is what you're saying.
Which can be painful at times.
Especially natural accountants don't like the idea of talking.
Right. Don't look them in the eyes. Just talk down.
No. And what was your degree, Monk?
No, accounting.
Accounting. I thought so. And my father was an accountant. And one of the things I want to try to explain to you is this, is that we're Akers Financial Group, but we have a company in our offices named Daniel Allen Tax. Daniel Allen Tax, A-L-A-N. That is a separate company. It's a tax preparing and bookkeeping company. We have two full-time tax preparers, one part-time, actually a couple of part-time tax preparers, and a team of like 5 or 6 people that run Daniel Allen Tax during tax season. And we believe the combined tax planning of that tax business and Akers Financial Group's financial planners and looking over that tax return adds a lot of value.
I can't tell you how many people are just so happy to have it done in one place.
Yeah.
But, that's not even the real value. It's convenient.
Yeah.
But us as planners, being able to do things proactively for your taxes, we're not just spending the whole year and then at the end we're like, oh, let's see what we did.
Yeah, our existing clients, we actually have our tax prep company do the estimate, and then they know what's coming based on the things that we have done during the year to help your taxes do better.
Right. Like you never want to sit down with your accountant and be like, I owe how much? Like you want to be like, oh, I was close or I was a little, that's tax planning, right? Like let's pay taxes on our terms.
Yeah. So what's happening is this. We really feel like you should do a show here. It's the beginning of February. It's tax time. And some of us are racing because we think we get a big refund. Some of us know we owe, so we just pile it up. The idea is this. You got to put some work into your taxes to be able to pay the least amount. So the idea of an art to taxes is really being creative within what you're doing and where you spend your money, where you spend your time, how you bring it all together. All very, very important things. The show is not going to be about line-by-line special deductions, but the concept of planning for taxes. Don't just file it and forget about it. Don't rush through this thing. understand that financial planners, we ask for tax returns and we love to review them to see if what you tell us is reflected in the return.
Right. And, I met with the client. Well, let's just call him Uncle Bob because his name is Bob. And I'm looking through his tax returns, right?
Yeah.
And I see you've been contributing to this IRA for, 20 some years. Did you ever tell your accountant?
They never did, really?
They never did.
Oh my goodness. So they also never gave the form from the IRA saying how much was put into it or anything like that either.
So, in that case, we can go back 3 years and usually change a lot of stuff.
So that was a deductible IRA. They weren't taking deduction?
Right. They never took the deduction. So I had to switch it to a non-deductible and then plan for a year where we could have a big Roth conversion before we rolled out his retirement account from the
you had to amend 8606 forms for long term.
Right.
Hey, we're dropping some big numbers at you with the 8606, but imagine that the IRS has forms where you report your history. One of the forms we find missing in many returns is 8606. That's a form where you track your IRA's cost basis. So if you put money in an IRA and then you don't get the deduction, if you don't do an 8606 form, what happens is you're going to pay tax on that money again later.
Right. And you just thought, hey, I'm putting it in here. I'm getting a break on my taxes, right? You just assume that everybody knows.
If we get your break, it's good. But if you don't, like that Uncle Bob who didn't file, he didn't get a break.
Right.
Thus, it's a non-deductible IRA
he
contribution.
Could have paid double tax on it if we didn't catch it.
Absolutely. And so that's a small thing, but honestly, it's about what you're doing and then telling your accountant what's going on. The accountants in January send out lovely packages of information, questions based on the year before. The most important thing is to make sure you tell the accountant what changed. Did you buy a house? Did you move? Somebody move in? Somebody move out? What's going on? Did you have extra to charity? Did you donate time to charity? Did you drive for charity? What do you do in your life? What is your thing? And understand that some of that can be tax deductible. Some of it might not be. But generally it goes like this. We want you to pay less on your taxes, but we want you to pay the proper amount within the limit and understand your plan, because it has to be part of your plan.
Right. I mean, if you're just searching for the biggest refund, in my brain, that's poor tax planning.
That's an advertisement. A lot of companies put out there, we'll get you the biggest refund. We guarantee you the biggest refund. It's like, is that hocus pocus? How do you get extra refund?
Right. So I know that that's just made up. What it sounds like to me is that you loan the government money all year.
Yeah, well, if someone, I was saying, what if someone's doing your taxes and the first question they ask you is, hey, what refund do you want to get?
Well, then,
you run away, right?
That's not necessarily gray area. That's like...
Yeah. So in taxes, honestly, remember, white area in taxes is obviously the right way to do things. Gray is where you need to interpret some of the law, interpret some of the IRS rulings, understand how to apply it in a situation. And then there's the obviously wrong tax situation, which we've seen on tax returns. And we've had situations where we had to go back and fix it. Oh, yeah. People living together in a house, married, and they're doing married, had a household double. Weird situations.
I think we had one guy that said, I don't need to tell them how much my Social Security was.
Yeah.
They know.
I had somebody that worked for, I had a person that worked for a tax preparer at one of those national companies. He did his own, and I saw it and I go, how did you get these numbers? They don't add up. He goes, I just figured out what I needed at the bottom and made the numbers work. Mm-hmm. And his wife just turned white, like her face just like, it was awful, because the reality is that it was so wrong, and they did get audited, and we had to amend things. So it goes like this. We're talking about planning your taxes, don't just file. Here in the first quarter, we're really trying to give you the idea about, hey, what are you doing? Have you even thought about it? Because what happens is when you take your tax things and you throw them down and you walk away, understand those questions are very important to answer, and answer them properly. When they say, get me a receipt, guess what? Get a receipt. One of the best things I found was an app that tracks my driving. It tracks my mileage, and so every day, every week, I'll send my app, I'll update, was that business or personal? And so I'm doing that the whole year long, and at the end of the year, I'll also have all my miles broken out between personal, charity, and business.
And medical.
Because each one of them can be deductible if you itemize.
Right. Well, and then so for you, it's kind of different because you're a business owner, so your mileage gets a little...
Yeah, when you add a business into it, then you can do even more tax planning, which we love doing that. That's That's an exciting thing to help business owners do better by keeping more of their money with proper tax planning, not just at the end of the year saying, well, what is my number?
Right. Because if we think about it, Brian, who's going to spend your money the best?
Uncle Sam.
Yeah. I mean, how many people say that, right?
No, nobody.
Like what you want to do with your money, that's the most important thing.
Yeah, that's going to be better than Uncle Sam can do with your money. I mean, Uncle Sam's going to get a portion, and they should. I believe the government needs to keep going of the services they provide, but they shouldn't get more than your proper share. You should give your portion that is within what you do with your money.
Right. And people that's like, oh, we shouldn't pay any taxes. That's, that makes no sense to me. Like, how'd you get anywhere today? Did you drive on a road?
Yeah.
Like, did you stop at a traffic light? Like,
yeah, I mean, from the police to emergency services, that somebody has to pay. They need money for that. I mean, we can argue about the government spending, where it goes, but they are essential services, no doubt about it.
Right. And then the rest of the money, the more that you are able to keep, the more that you could give to your charities, to your family, whatever you want to do with your money. Like, that's the important part here. But if you're just piling those papers down at the end of the year, I have no clue what I did. Then you're going to get a result that, I don't like surprises.
Or if you just don't take time to get ready before you go, that I think you need to spend some time. What I mean by that is throughout the year, like in 2023, you should have had a 2023 folder that you put everything into so that you don't forget about it later, because trying to recreate the history is very, very hard. So what happens is this. Yes, the show's called Winning in Retirement. Now, that's a goal for all of us, is to win in your retirement years. But guess what? You need to win today. You got to win the game today. You got to win during your lifetime. Because if you pay less taxes, guess who gets to keep it? You do. And that will be able to be there to help you for your retirement. Because we know the best part of retirement is about getting your time back, where you decide how to use it. Before retirement, your time is tied up with other commitments, mainly your job. A lot of that goes away in retirement years. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. Go to our website at akersfinancialgroup.com. Scroll to the Schedule a Meeting section and let us know you'd like to schedule your free consultation with one of our team of advisors. That's akersfinancialgroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to akersfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. What is your tax bracket? Do you know? We'll discuss this when we return.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm your host, Brian Akers, certified financial planner practitioner from Akers Financial Group. And today we brought in Alex Monk, certified financial planner practitioner, also from Akers Financial Group, accounting major, and a person that we've learned to love over the years, or grown to love. How do you feel about this, Alex? Mr. Alex Monk?
Yeah. I mean, people that love me really love me.
Yeah.
Well, but,
Nice. And some people laugh at your jokes, some don't.
Some don't.
Yeah. But the idea is this. It's not about any of that. It's about, do you know what you're talking about, and do you take care of our clients? And the answer is yes.
Yeah, that's my thing. I get jacked up doing the right thing.
But comes to taxes, I think this is one of your like if you're pitching baseball to you and you're hitting a home run, you have a home run spot.
It's my wheelhouse.
Yeah. Now, I know that you have a special thing in your history as a child, and that was when the Ironbirds
Ripken Stadium.
When Ripken Stadium opened up, you were the pitcher to Cal Ripken on that opening day, right?
That's the peak of my athletic career for sure.
Did you throw a fastball at him? Not at him.
Yeah, like I did this interview with the newspaper, and they're like, Emerton boy throws Cal Ripken Jr. a curve. And really, I was just trying not to hit the guy.
Yeah. Well, the coolest thing is you threw a ball to the new owner of the Baltimore Orioles. Partial owner, sorry.
Yeah. That's
pretty cool. Yes, it's the beginning of February 2024, and this show is about taxes. Plan your taxes, don't just file. The reason I want to bring up all these things is this. Imagine that planning and taxes should be a conversation, not where you walk in and dump it and run out the door, where you upload and just get your number. Make sure you're getting information back and forth, make sure you answer the questions that they ask. The process at the tax preparing company we have, that's a separate company called Daniel Allen Tax, is they gather information through uploads or people bringing it in, and then they look at it, review, and then they come up with more and more questions. They also, most of the time for Akers clients, they run them by us to see if there's any other things we can do before you hit that send button,
If your accountant's not asking you any questions, there's a huge problem. Because I mean,
W-2s you got two. All right,
you're done.
It might
right?
be simple if you got two W-2s, but you need to make sure.
Just ask them the questions. I mean, even if it's just a young kid, like, hey, did you go to school? Did you do this? Did you do that? Do you live at your parents? All these different things, and then maybe you have to talk to their parents.
Especially, you're taking the deduction as a person, but your parents are also taking your deduction.
Right,
Not
and then you
work.
get into this whole who filed first, who got the refund. But there's a lot of different ways because everybody's scenario is super different. There's no magic bullet out there. But like you said, Brian, you got to put in a little bit of time, right? Like remember what you did.
Absolutely. Now, this quarter, the second quarter, we're talking about. We're beginning our talk on something called tax bracket. And so my question to you is, do you know what your tax bracket is? Alex Monk's going to try to explain tax brackets, and we're going to try to just give you the idea of why it's important and understand some tax bracket language.
Yeah, so picture steps, right?
Yep.
And these steps, they're like at a park, like a natural park, where sometimes you can go up one step with one leg. Sometimes you got to make that awkward double step. That's like being in a tax bracket.
Sometimes the step's huge. You need to climb up and grab it. And
sometimes you got to have that railing. And you need to know where that is, right? So the brackets 0, 10, 12, that's all fine, right? And then you go to 22.
So it goes from 12% of federal tax bracket to 22, almost like a cliff, right? That's a 10% increase.
That's a jump. It's almost a doubler.
It actually sure feels like it, and it is, right?
So, and other things happen at that tax bracket. Like there's all these different type of shadow calculations. One of those is called capital gains. Mm-hmm. So if you're in the 12% bracket, you might pay 0 on your capital gains, which is a massive deal. So that's 0 to 15 on your rate there for capital gains. And people are always like, so it's the capital gains included in my income, but it's not if I don't go over a certain level. So it's a strange calculation, to say the least. But it's a huge deal, right?
Absolutely.
Because if you're planning to take a big gain, you need to know what's that going to do to my overall taxes. Is it going to jump my Medicare? Is it going to do all these different things? And plan for it appropriately. If it's a huge windfall, you can't. Then you got to do what you can.
But when I'm thinking about what you're saying, I'm thinking about for 2023, that's the return we're doing now. And so there's some things we can do to help our 2023 taxes, but you need to know your 23 taxes so that you can then also plan better in 24 with your taxes. So knowing your bracket. Now, the bracket comes off something called taxable income. What's the difference between gross income and taxable income?
So your taxable income is after all your deductions.
All right, and that's standard or itemized.
Whichever you qualify for, which you should check them both ways because they have impacts on your state return.
Can you explain that a little bit more?
So when they changed the tax code, a lot of people didn't qualify for itemized deductions.
Because back in 2000, the Tax Cut Jobs Act of 2017 affected 18 tax returns, and most people do standard deduction now because they combine the standard deduction and your exemptions all together.
Right. Yeah. So now it's a bigger number.
Yeah.
And they limited other things in that deduction. So a lot of people don't necessarily qualify for that. But what it does is it has a big impact on your state taxes.
Right.
Because your state taxes are going off of how did you do your deductions on your federal tax.
Yeah. And so if you build your itemized, so one reason to track all those itemization expenses is just to see if you qualify. And if you do qualify on the state, you might take standard for federal too, and then before you know it, you overall make more money. So that's running your tax return twice.
Yeah.
Which is a standard procedure by people that work with taxes on an everyday basis.
Yep, just to see what's the net benefit to the client.
Absolutely. So let's tax brackets. We talk about 12 to 22. Now, just give me a rough number. What's the high end of for taxable income on a 12% bracket for last year's taxes, for 23 taxes?
It's roughly 190, or no, 890.
It's 90, and then in that bracket,
That's for married.
That bracket for married is 90, and so for single, is it half of that?
Roughly half, 44 and change.
All right, so the hard part is a lot of people file single, and then they don't really realize that if you have a $50,000 a year job, $60,000 a year job, after deductions, you're right near jumping that next bracket. So any other income, you're kicking to another bracket.
Right. So imagine you had a part-time job and they didn't know that you had other income. Like their payroll software has no clue.
Yeah, that's why people with multiple jobs, many times they owe taxes because no one's taking tax out. And people don't really realize they can tell this employer they want taxes taken out. You can tell them, hey, $25 out every week I work, $100 out every time I get paid. You can make them take taxes out, and that's what you have to do, especially if you have multiple jobs, because they usually think you're one job and they won't take out enough tax.
Yeah, the payroll software just assumes that this is all the money you're going to make the whole year.
It also happens when you have one spouse making a lot and the other one making a little bit or working part-time. All of a sudden, one makes enough that gets us into the next brackets or so, and the other one's making enough where they wouldn't be, and they get 2% taken out, and they really should add 24, 30% taken out. That happens way too often.
I've seen that one so many times, and then you get into like that weird contention, right, between people. You see them, like you can see in the conference room, they're like, they look at each other like, why, but it's just,
I told you to take more tax out.
It's just something you got to talk about, right? So you don't run into these big,
Yes, imagine planning. You walk into a financial planner's office, and then I think they should always look at tax returns. If they're not, I don't think they're doing much planning. The taxes are a big deal. If you think about our money that goes out the door, taxes and insurance, that's half our money. It just feels like that's running out the door, and then we got to live off the rest. I want more money to keep.
I don't know how you can invest somebody's money without looking at their taxes. It's just crazy to me.
Yeah. Well, I'm thinking the laws are making fiduciaries actually look at people's information in a greater detail than said, hey, what kind of income you make? You need to know about their tax returns and see the effects of what they're doing to your tax returns. So you can see how it flows in and try to keep your income at the proper levels. Now, tax planning at the higher levels is really incredibly important. Now, explain when someone jumps from 24 to 32. What are the numbers like there, Monk?
So on the top of the 24 bracket, we're at 364.
Yeah.
And then you go 364 to 462, you're in the 32 bracket.
Then you start running up. The highest bracket right now is 37. Is that correct?
Yep.
Now, 37 doesn't mean that's all the federal taxes you pay. Once you get above $250,000, they've added a 3.8 like an investment tax.
Surtax. It's like when you get knighted.
Okay.
Make enough money, you're surtax.
And now most brackets, as you move up, only the dollar above the bracket gets taxed at the new rate, but there is some alternative minimum tax and some other things in this thing where you have to sort of know, and that's when you need to bring tax experts as part of your financial planning team. Is tax experts, financial planners, advisors, money managers, all brought together. And that's what we do at Akers Financial Group is we bring it all together.
Yep. And we help you do it throughout the year. Like I like to meet with people in November and I'm like, hey, how much money did you make this year?
Yeah.
What can we do now?
Right. So when they come here in January and we're trying to plan 23, only a few things you can do. And one of them is maybe an IRA deduction, right?
Maybe.
You have the April 15th on that, and that's it. Maybe you can look at your business and try to make sure you took all the right deductions. You can research the information. When someone's itemizing, I like them to then look at every expense. Do you work for a charity? Do you volunteer for a charity? All that mileage, you get a little bit of money for that. And if you're already deducting or itemized, you might as well add more there.
Yeah, and then we help people. Giving the right way is always a big deal, and then we'll touch on more of that later. But like the smartest way to give your money to your charities. It's a big deal.
There's a lot of choices. A lot of it has to do with your unique financial fingerprint. Taxes is a part of it. Plan your taxes. Don't just file. That's the name of this show. Understand the premise is this. Hey, are you turning your taxes in, dropping them off, or are you going to have a conversation with a tax person? Now, we think you ought to sit down and talk to a tax person. At least when you pick them up or when you drop them off, you should have a conversation. Now, a lot of tax people like you to upload, download so they can take a quick look and then get your questions. So that's more efficient for them so they can get it done quicker and keep the fees low. The idea is this. Akers Financial Group, everything is about you. And what we mean is this. if you need to redo your taxes, you can redo them and actually amend 3 years back. And if there was a mistake that we find, you can fix it and get your refund. Beyond that, still makes sense to file and amend and fix things. You might not get the refund, but when you correct the IRS information, they might stop taking money out of your pay because they understand that, you're caught up now. Getting your taxes right and filed properly is very, very important. And that's why at Akers Financial Group, we do affiliate with our company, Daniel Allen Tax, Daniel Allen, ALAN Tax. And that website's danielallentax.com. Check that website out and get to know some other people here at Akers Financial Group that work at that separate company, Daniel Allen Tax. Taxes are all part of this unique financial fingerprint. It's not about us, it's about you. So give us a call at Akers Financial Group for 833-WIN-RETIRE. Schedule an in-person or Zoom meeting with one of our team of advisors. That's 833-WIN-RETIRE or 833-946-7384. 2 years till the current tax law is sunset. Should you pay more taxes now? We'll explain in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Hey, indeed. Welcome back to Winning in Retirement. I'm Brian Akers from Akers Financial Group. Here with me today is Alex Monk. He is a certified financial planner practitioner and been with Akers Financial Group 13 years. He's here with me today on the show like he's been for years now. Plan your taxes. Don't just file is our topic. Alex, I know puzzles and figuring out what's best for a client and getting them more money now and more money later is all about planning and making sure for a lifetime people pay less than they currently would be. And so this topic for this quarter is 2 years till the current law sunset. Should you pay more taxes now? What are your thoughts and what's your thesis on this comment?
Absolutely. So one of my biggest pet peeves is paying too much tax. Like, it drives me nuts when people just don't do the right thing and they pay too much tax.
Yeah.
So I always want to look at it like, that's what people say they love about me, right? I love that you do the tax planning, Alex. At least that's what I hear.
I'm sorry. I mean, do you make them write a list of what they love about you? Is that part of the interview?
I can glean these things in our conversation. That's the way I like to structure things, right? And a lot of times, some people want to go way deep in the weeds, and I can make your eyes roll back with tax code stuff. But some people are just like, I'm so happy you're looking at my taxes too.
Yeah.
Because paying taxes now is a good thing.
What I found is the more successful people are, and they work so hard for their money and their wealth, they don't want to keep giving more and more because it always seems like you hit another bracket, and there's more taxes going out. And if you get half of it to bring home, you feel lucky. And in some states, if you keep 45%, you feel like, okay, I made some through. And so the idea of tax planning is truly trying to pay less taxes. Now, the Tax Cut and Job Act of 2017 lowered tax brackets across the board down. In other words, 15% is now 12%, 25 became 24, even the 28% bracket became 24, and then the highest bracket back then was 39.6, and that dropped to 37. So that was a good thing that the brackets changed, and when they changed the brackets and lowered it, it made the effective rate, since that law was passed, to be the lowest in the general last 30, 40 years. On a consistent basis for federal tax. Now, people would say, well, my deductions change. I can't take a SALT deduction. What's the SALT deduction?
So that's your state and local taxes on your itemization.
Yeah.
So, in states like Maryland, it can hurt you a little bit, where if you're a high income earner, you might pay a lot of Maryland taxes. Right. You have a big house, you might have big property taxes.
Multiple houses, you're limited to a $10,000 cap on your state, local and real estate tax.
So what I've found that overall, we're paying about 2-3% less.
Yeah.
And right now we're at, historically, some of the best rates that we've ever seen.
Yeah, the high income, you might be about 1% to 2% less, depending on how you're doing your corporations, your S-corps, and other pieces. But or if you have real estate, you might be in a lot better shape. Real estate has a great 20% profit, and then the whole tax special qualified business profit is a good deal.
QBI,
under certain limits is really incredible for business owners. And people don't understand that showing a profit right now is a good thing to run some profit out of your companies onto the return.
Yeah. And that's a weird thing to hear. Like, you hear all these tax commercials. Oh, we'll get you the biggest refund. We guarantee it. Mm-hmm. Well, I'm telling people, hey, we're going to pay as much tax as we possibly can in your current tax bracket this year. Yeah, and they look at me and they're like, what?
Well, so the idea is this. If we can pay tax at a 12% and get it into your pockets or get into a tax-free vehicle and let it grow tax-free and never pay tax again, you're a long-term winner.
Absolutely.
So this planning of getting that money into tax-free vehicles means you got to pay tax now unless you use special exceptions such as HSA, where you can do a little game of pre-tax and never tax. The very few other things can do that. But the idea of getting this money, paying it, and getting tax-free later can fit for some clients. And that's when we got to identify that and say, hey, this is what's best for you. This is going to make you not pay taxes on this portion of your money.
Yeah, and so a lot of people that I meet with, and I know you get a lot of them too, they have a lot of money pre-tax.
Yep.
Which means to get that money, you got to pay tax.
It's not all their money. So if they're a 401k millionaire or multimillionaire, if it's $4 million in there and all of a sudden you're going to be in the 40% taxes, that's $1.6 million that Uncle Sam and the local state gets.
Right. So like what I do with people is like, okay, let's find that Medicare limit, or, if you have pensions, whatever you got going on, depends, different people, different income targets. Yep. But a lot of times it's the Medicare limit.
Yep.
Right. Because we jump that and it's,
Irma.
Yeah. Old Irma comes in, slaps your hand with a ruler, and your Medicare basically doubles, whatever that equals, $3,600 per person per year, something like that.
It goes from $174 a month all the way up to like $500 and some dollars a month max on Medicare per person. So they're talking a couple that was paying $334 or $338, and then all of a sudden they're paying over $1,000 a month if they had too much income. And so we've had to file some exceptions through SS40 and a bunch of other forms for people trying to make sure they don't pay too much on a 1 year type of income bump that got them too high.
Yeah. And if you're listening, you're like, well, I don't want to take it out right now. I want to let it grow tax free, all that. But what we have is a problem down the road when you have to start taking the money out.
It's a snowball going downhill. If you don't pay the tax and you invest properly and grow the money, that snowball gets bigger and bigger and bigger. They're going to want to take tax out on that money some point in time. And at 73, 75 is when that comes to fruition, where you have to pay the tax.
You got to do it. And then people are like, well, Alex, I'll just convert it to Roth. No. No, you can't do that. You have to take out your required minimum, and then you could convert it to Roth.
Yeah, above, yeah.
So then you're already, miles high in your tax bracket. I see people, it's like, congratulations, you're going to turn 75 this year, and your income's going to be higher than it's ever been in your entire life.
Yeah, a lot of those are great savers. We have a lot of clients that are wonderful savers. They put money away. They still have their first dollar saved. The hardest part is it's all growing. In some cases, it's not growing tax-free. Now, we try early and often. The younger the people are, we start them in the Roth, killing the Roth side, Roth option, Rothification, cash value life insurance, trying to find tax-free ways to build up some wealth so that you have buckets of money later in life that's not going to hammer you. That means you might pay tax now. And with the way this tax is sunset in 2 years, so in 2026, our brackets are going back up the way they were in 2017. That's what the law is now. Yes, the law could change, could get better, could get worse, but we know our taxes now. Sometimes if you know the taxes, you pay it now and never again.
I hate the unknown, right? Like, it's terrifying. And then you have all this speculation and all that. But I would say that when they change the tax code compared to now, we have more debt as a country. Agreed?
Yeah, we have more debt every second we've been talking.
Right. So that's pretty clear. So we can assume that they're going to at least need to keep taxes the same.
As interest rates rise, which means more money going out the door for paying for the debt, it's just a matter of fact that they have to get more money.
Some way, somehow.
Absolutely. It's an election year in 2024, so there's going to be a lot of talk about lowering things. The reality is, have they really addressed the really large issues down the road? It's a give and take thing. There is ways to grow us out of things. It's all about economics. Taxes are a part of it. Problem is, you have to apply it to you and to your unique financial fingerprint of what is best for you and your family. I like the idea of retiring with choices. Imagine you have a choice. I have a liquid fund that's taxable. I have a tax-free fund that I can get money out anytime I want, no tax. And I might have some pre-tax because I want to get those special deductions back during my working years. So having multiple choices in retirement is a great way to be. Sad part, most people only have one bucket. They usually don't have multiple.
Yeah, and so this year's going to be kind of interesting, Brian, for people that, it's kind of been the heyday where you didn't have any interest income for a long time. And now people are going to have interest income. A good bit.
My worst case was I had this client last year who's rolling all his CDs, and he has a lot of money in CDs. And I was explaining how tax-free bonds would be a lot better for him. And I ran his bottom line. If you pick up another $200,000 of interest this year, all of a sudden, how much pushes everything up higher? And I ran his tax number, and he just stared at it for a while. We did some tax-free investments for him.
Yeah, so that's the thing with interest income. Like, hey, great, I'm so happy you're making 5% or whatever on your bank money and all your CDs. But interest income is the worst type of income you can ever have.
So I have this one client, a very successful couple. They receive inheritance. He's still working. He's at the highest income of his life. And I basically explained to him that he needs to do Roth at his work, pay tax now, even at the highest of his life, because when we take all of his savings, all of the inheritance, all this money that have accumulated, they're going to stay at this high bracket well into their 80s at minimum. And I was explaining that if brackets stay the same, you should do a Roth, because if brackets stay the same, why not be tax-free? If brackets are going to go up, obviously you should do a Roth. But he didn't have any Roth at all when I first met him. So now we're building a Roth side. Roth is a tax, you pay tax now, never again. So even at the highest brackets, Roth has worked.
So do you ever get the question, I get this sometimes, well, I heard they're going to take Roth away.
Yeah. I said they might. And whenever they vote that in, typically they have grandfathered laws in, and you keep what you have there. You just can't do any more of it. It's like if they change the rules of the game, we readdress what we're doing, and we build from there. We might not be able to do any more Roths. So I think the opposite. Let's say they're going to take it away in 26. Hey, you got 2 years to do a Roth. Better do it now.
Right.
Let's get in a hurry and get those Roths done. Fund your Roth IRA. You got to April 15th. Let's get money in there.
As much as possible. Pay the tax now, and then down the road, that $100,000 car doesn't cost you $150,000.
Absolutely. If you put $50,000 in, it's worth $100,000. It's all Roth. It's tax free. Did the car really cost you $50,000? Or it's nice. It's a lot better way of thinking about your money when it's tax free, which is nice. But you got to pay some tax now. So this quarter was all about understanding that tax laws are changing on January 1st of 2026. The tax brackets are going up, and a few other things will change. And we need to pay more tax now in some cases. Understand if that applies to you. Make sure you sit down with one of the people at Akers Financial Group, because we're local, we're independent. We don't report to a big company on Wall Street or a big company in Iowa. We report to you. We do have offices in Lutherville and Forest Hill, and we meet clients all around the Mid-Atlantic region. We have regional spots. We meet with people. We love to sit down and talk with you, or have a Zoom call with you and get to know what's going on in your situation and see how we can add value. Just go ahead and give us a call and schedule your free consultation with one of our team of advisors. Call us at 833-WIN-RETIRE. That's 833-WINRETIRE. We'll give you a call on Monday to schedule a free in-person or Zoom meeting. Go to AkersFinancialGroup.com or call us at 833-946-7384 to start planning for your retirement now. What can you do to increase your refund? We'll talk about that in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. Yeah, the radio podcast put on by Akers Financial Group. We welcome you to go to our website, AkersFinancialGroup.com. That's AKERS financialgroup.com. I can't spell financial, so that's good luck with that.
There's a lot of I's in that word. I'll just stay away.
All right, so that's Alex Monk on the microphone. He's here with us today. Also a certified financial planner practitioner. Being a CFP is something that's very valuable to us. It means we put in the work to become a CFP. We also, each year, have our things we sign about being an ethical fiduciary for our clients. There's a process of doing planning. And that's how we do business. That is different than a salesperson, different than someone who has a product and they're pushing one product to you. Understand the difference in a CFP, so you can sit down with one of our CFPs here at Akers Financial Group. We have a bunch of CFPs at Akers Financial Group, and I have a bunch of them taking classes, which is nice.
Right. Like, so if you're meeting with your guy and everything he says sounds too good to be true,
yeah,
then it is.
I was going to ask where you're going with that. We don't have time for that. This is the fourth quarter. We got to finish the game. We got to win the game here in the fourth quarter. Fourth quarter is a great time to really focus on what we've covered and understand what we're trying to accomplish. This quarter is about this question: what can you do to increase your refund? Now, there might be advertisements out there to say, "Oh, look, we'll guarantee you the highest refund." That's a tough thing to promise because you're not going to add to someone's refund. You just got to make sure you ask all the right questions to get the best refund. That's all I can think of, right?
I have no clue how they guarantee that.
Yeah.
Like, it's just impossible. But what a perfect thing to guarantee.
Yeah.
Something you can't check. I mean,
well, the hard part, it's like when people come into us and we ask for 3 years of tax returns in at the back, the ones that you already filed 3 years ago, and we bring those in and look at them because we compare them to what you tell us. And then we look at them to see if there's any way to save you more money to increase your refund. Now, Alex, have you seen situations where you've been able to help clients that do that?
Oh, I mean, all the time. So when they come in first, second meeting, they'll be sitting there talking and I'm just pouring through their tax returns. And I'm asking them questions like, what is this from? What happened here?
Yep.
Who died? Did you buy a house? What happened here? And a lot of times they're like, oh, my accountant didn't, he didn't talk about this or didn't do that. And I'm like, well,
yeah,
if you get your taxes amended and it costs you, a couple $100, this is how much money you're going to get back just because it was done wrong.
Real simple things recently was we were talking about they've been putting $2,500 per kid into their Maryland 529 plans, and I'm looking at the state return. I said, "Did you tell your accountant that?" They never asked. I said, "Well, that's a deduction about $190 per the $2,500 deposit, so we can save $800, $1,200 just by amending your Maryland." And getting that piece. That was a simple thing about 529, using the Maryland plan, knowing it's deductible, going back, because honestly, if you gave money like 5 years ago, you can go back and amend that. You won't get the refund, but if you gave a lot of money to a 529, it actually carries forward into other years. So knowing your facts and applying them is extremely important.
Right, and that's where we were talking earlier about your fair share. Like, the state is not going to come knock on your door and give you a check.
Oh, Alex, you forgot the 529 deduction. I don't believe that's a cross check that they're going to come back with.
Absolutely.
They might say your 1099 didn't match and you get some more money. But generally, these I love you letters from the IRS 2 years after you file are normally asking for more money, usually more information. We usually don't panic with those. We work with the accounting firms. The one we have locally in our offices and the other ones, we work with them. We talk about, all right, this is what really happened. Here's all of our data. Here's all our proof. So we can prove it was properly rolled over. Things are properly done.
Right, because there's some things that you have to tell on your tax return. It's not going to be shown anywhere else. Yeah. Did you donate? Did you drive to charity? Like, all these things. Yeah. Like, they don't. The government doesn't check your Facebook to see if you don't, spent time at charities. Like, you need to tell them.
I had this wonderfully brilliant lawyer. I mean, she's amazing. And the hardest part was she didn't have time for her accountant. I mean, just didn't have time for it. And so I said, let me look at them and see what's going on. And she was doing a backdoor IRA, which is a great thing to do. The problem was the accountant didn't do any of the work, any of the paperwork to make it a backdoor Roth. Backdoor Roth is a great concept for those that have too high of income to make a Roth contribution. If you don't have an IRA, you can put money in that's not deductible. You got to track the cost basis, and then you convert it into the Roth, and you've got money landing in your Roth. But I mean, it was a case where not because she didn't understand, not because she wasn't smart enough to understand, it was just she didn't have time. And the accountant and the financial person she was working with then just didn't communicate together. So understanding your team needs to communicate. Your financial advisor should talk to your accountant. We think they should. We think the accountant should talk to the financial advisor and say, hey, anything go on this last year? We have CPAs call us all the time. Hey, what happened with them? And one thing is QCDs, right?
That's the one, it's called qualified charitable deduction, right? And yeah. I think it's just magic. I mean, it's just one of the best things I've ever seen on a tax return.
And that's for anybody over 70 and a half. You have the ability to use your pre-tax qualified IRA money only to give to charity and lower your top line income.
I can't tell you the number of people that walk through the store for the first time, and I'm like, oh, so this is where you go to church, this, yada, yada, yada. Yeah, and you give money, don't you, right? Yep, standard deduction. And they're taking money out of their IRA. So the QCD lets you send that money directly from the IRA to the charity.
Yep.
No one pays tax.
And so the idea for the whole show today has been plan your tax, don't just file. These are great examples of how to increase your refund with what you're already doing. What you're already doing. Understanding that questions like, you're retiring, you're going to volunteer more. Track your mileage. If you're going to donate things to the charity you're working with, you could build up enough deduction through those donations, especially if you're single.
Yeah, I mean, definitely. If you're single and you own a house, there's property taxes, state taxes.
Right.
If you give away $5,000-$10,000, I mean, then you're right in the wheelhouse.
You're getting up to that itemization bracket, and before you know it, you can deduct mileage where you're being a leader of a charity. If you're a basketball coach, let's say, you can deduct your mileage to be a basketball coach if you're not getting paid. So if you're a volunteer position, you can do it. If you're getting paid, you can't do both. It's not charity when you're getting paid, right?
Well, I mean, charity stripe, there's so many things we could go down that sports rabbit hole.
All right, so the idea to increase your refund. All right, so Alex, someone comes in and ideas for increasing my refund. I always ask them, hey, are you a business owner? And then through the business owner, or do they have a business on the side? Or do they have a hobby where they're actually going to craft fairs on weekends trying to sell things? And I'm like, that's a business when you're trying to sell.
Did you get a 1099 NEC? Like,
yes.
Did you deliver 5 things from Instacart?
Yep.
Magic.
Say that again?
Like if I have this one client, I don't know. I think he does Instacart for fun.
Okay.
It's where they go shopping for other people.
Yeah, they're a private shopper.
Yeah.
Okay. But he gets a 1099 for
doing it.
He
gets a 1099?
And so that goes right to his return, other income, and no deductions, fully taxable, nothing.
Painful.
Yeah.
But, luckily he's a client of ours.
Yeah.
And knows that that's a business.
Yeah, and we can run a retirement plan against it or some other things, right?
Yeah, but we can offset most of that income very simply.
One of the things I found recently is these companies converting people from W-2 employees to 1099, and then they give them the same money. And then they come in and we say, oh, what happened here? Oh, I'm 1099. I still get the same money. I said, well,
no, you don't.
Are you handling that extra 12.56% besides federal and state? What's that? And so we have to teach this new business owner, when you get 1099, you're a business owner, what their options are.
Yeah, and so if that ever happens, I always try to negotiate. Well, if you're going to pay me $10.99, you need to pay me 20% more.
Absolutely.
Or even higher.
You divide that number by 12.56 minimum.
Right. So you take
that'll give you a raise difference, I think. Sorry, my math might be off right there.
If you divide it, it goes back up. Carry the 1. I think you weren't carrying the 1 there.
No, 12.56 is the Social Security portion of self-employed, and that percentage of that income. So it's like $1,256 every $10,000 that just goes to the FICA Social Security. That if you were employed, the employer would pay half, and you would only pay 7.65. Yeah. So it's a 5% increase, and then usually on 1099, no one's withholding. So before you know it, you owe. This is how a lot of people get deep in debt. And I've had emergency room doctors flip from W-2 to 1099.
Oh, that's brutal.
Because
they're like, I got a raise. Check it out.
They're working 90 hours a week, and somebody else is cashing their check. They don't know what's going on.
They got no clue.
Until the IRS comes in and go, hey, you owe $75,000. And like, to what?
What do you mean? I got a raise and I have a new car. But that's the thing. It's like if you...
Yeah.
Like why I like meeting with people in January, too. It's like, we can get more money into your retirement plan if we just go up 2% today.
Yeah.
If we go up 2% in December, the year's over.
Yeah, so imagine this. You need to plan your taxes, don't just file. So for 23, there's a few things you can do to help your 23 taxes, but you can do a lot for your 2024 taxes. And that begins with a conversation with a financial advisor that brings taxes to the forefront of your conversation and leads you down a path of what do you want to accomplish, what do you want it to look like, and do you want to keep more of your own money?
Absolutely. And that way I can give you a real answer on what to do with your money. Like, why do we hold certain things in different accounts? It's because of the taxation. And if your guy's not asking you that, you need to do something different.
That's why owning stocks in your taxable account makes sense, because of qualified dividends or less taxes, capital gains or less taxes. Understanding how they all work together is pretty nice. When you have a CD and the CD pays you interest, it's ordinary income, full tax bracket. if you're getting a dividend, you'd actually pay less tax on the same amount of money.
Or potentially zero. So if we just structure your investments to have the right stuff in the right accounts, it can save you huge money.
All right, so we wish you the very best during the 2023 filing season. I'm sorry, I shouldn't laugh at that. Some of you are excited because you can't wait to get that refund. Hey, don't pay someone to get you a refund faster. If you file electronically, you should see your refund quickly. If you file by paper, it's going to be slow. So understand that. File electronically if you want to see your refund quickly. Don't pay anybody to give you a refund faster. It's not worth it. It's like it's a high-end loan.
It's a payday loan. No, thank you.
Brutal loan. Yeah. So there's certain habits you got to understand, and that is this: plan your taxes. Don't just file. And one way to do that is give us a call at Akers Financial Group so we can help you with your personal finances. Right, Alex?
Absolutely. It's what we do.
All right. It was a good show. Went quick. We wish everybody the best here in February. Try to finish out the winter and begin the tax season. Wish you the very best with that. Thank you for listening to our show. You can always go to our website, akersfinancialgroup.com, and find out more and listen to past shows. Go to any podcast vehicle, and you can check out Winning in Retirement and listen to our shows and get to know us, and then come meet with us. That free meeting is yours. All you got to do is give us a call or go to our website at akersfinancialgroup.com, scroll through the schedule a meeting section, and let us know you'd like to schedule that free meeting. That's akersfinancialgroup.com, or you can give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule that free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to our website or give us a call at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Akers Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. Akers Financial Group and Archedios do not share any common ownership. Neither Archedios nor Akers Financial Group provides tax or legal advice. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and/or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.